Hello, it is the 12th of May, 2011, and welcome to the Silver Log. I want to start off with the definition of bipolar disorder. It involves periods of elevated or irritable mood, mania, which occurred in there, alternating with periods of depression. Mood swings between mania and depression can be very abrupt. Maybe Silver has bipolar disorder. And my personal belief is everybody has bipolar disorder within this definition of going through swings of up and downs in life. That is natural. You have weeks where things go amazing, and then for a while things just go to the toilet, basically. That's been human psychology, same way within the markets. To think that we're going to go from mania to depression and stay in depression, well, that would be absurd in my opinion. However, with that being stated, the market has been extremely volatile. The levels in which they are trading at, totally fake levels. Why are they fake? Because it is printed within paper silver. It has been the entire time, going back to the 1990s, the 1980s, probably ever since going off the gold standard anyway. It's been paper contracts going back and forth. Therefore, when we look at the financial collapse, currency collapse, what does that mean for the economy? Does that mean the stock market's going to collapse? Maybe not priced in dollars, but the system itself? Most likely. Same thing with the silver market, the gold market, the derivatives markets. The entire derivative markets are pretty much going. If you don't believe me, then please, and I do suggest, do your own research because I'm not telling you why they're exploding. That would be up for you to decide. Okay, let's get on with these technicals. The original move towards this 33 level found support at the volume weighted average and the volume weighted average, or the Fibonacci support level, managed to find a bounce up to the flat 50-day moving average. If we break below this line, the 50-day moving average is going to start to flatten out. As I was stating in here, all sell-offs are guilty until proven innocent within the rising 50-day moving average. For this to be proven innocent, it needs to break below this level. The 50-day moving average will start to decline. If it holds the 33 level, and even starts to trade within this area here, the 50-day moving average will flatten out. The market will no longer, it's not bullish anyway, the market will not be bullish, it would be neutral. Now the market is turning bearish on a fundamental technical level based on solely the 50-day moving average, and based on Fibonacci, it is leaving the bullish trend, but it's got to break below this 33 level. So far, it hasn't done so. Switching it up now to the hourly chart, I was mentioning about how this downtrend line was taken out. Didn't mean much. Well, we're back down below it. It was nothing more than a pierce above. It didn't find support in here, which really was the key spot. Because when you have a trend line declining as fast as you see here, it's not often that it stays below it, and it's really not that difficult of a job to find support and at least reduce the rate of descent. Of course, that hasn't happened. Normally, intermediate trends can last anywhere between 3 to 9 weeks. It's now approaching 3 weeks since this market top. However, the movement's going from 50 down to 33. That's normally what you would get in a 9 week period. So we've received the movements that we would normally receive in a 9 week intermediate trend in that of 3 weeks. The market obviously can continue to go lower. I mentioned yesterday the $29.50 as the next level. Also the main level of 31. Maybe I should just stick with the 31 level as the next opportunity where it should find support, but the way things are going with the volatility, hitting 29.50 would still be a pierce of the 31 level. On the short term, we've established this lower high. Therefore, in order to break this trend, we at least got to get above this level in here. The 5-day moving average used as resistance. The next test will be the second test of the declining moving average. The trend line on the short term would be the one I just pointed out in here. Overall, like I say, this has been one heck of a bloodbath. But then you get some sanity and understanding. Well, why is this market selling off when there's several delays at many different places? But hey, maybe there's a lot of silver that I just can't see. Maybe the powers that be are hiding it to us and lying to us. After all, they wouldn't do something like that now, would they? As far as the weekly chart is concerned, the significant trend line has been broken, but it hasn't been clarified. And it barely has been broken for that matter. Still pretty much at it. The second test of this support level, the first test occurred back in January. This is the second test. We're now at levels not seen since the month of February. Breaking that, the next level of support on a trend line basis will be this one in here. You also got previous resistance at $31 per ounce. Now the volatility has been quite wild to say the least. And this is the short-term volatility based on the hourly movements. Looking to see if it can get above this 4% mark, even really 3. So far, it's been showing as if they're not giving up. That means the major manipulators within the banking system, and I know some people are like, oh man, just because it's going down, you're saying that it's manipulated. And for some part, yes, but obviously the entire time it has been, but more so today when you got the amount being traded on a volume level, not only through the SLV ETF, but the actual COMEX contracts. Brother John put it well how much has been traded. But this volatility is to be expected during these end times and transition days. All these movements we are seeing is very normal for an economic collapse with a major currency death. Very normal action, pulling out all the stops towards the end. Now, as far as the daily volatility is concerned, the last 9 days of the silver market has had an average movement of 10.2%, 10.29%. The way this is calculated, you take the highest level of the day, you subtract it from the lowest, you divide it from the lowest. That's how much it is gained from the lowest point, so the average is 10.29. The highest level is 14%, the lowest is 4, and 6 of the last 9 days are over 10%. From December the 2nd, 2008 to April 29th of this year, which spans a little over 2 years, there was only one 10% day. That was a November day of last year. From September 29th, 2008 to November the 6th, 2008, there was an average. Actually, this is a typo. The average is 9%. I typed in 7. It should be 9. With 7 days over 10% and a maximum of 31%. So we're at the same average we were from this period in here. And I only have daily data going back to September 29th, 2008. And even before then, the market was very volatile. So we're getting back to how volatile it was in 2008. We have yet to have had a major day that is as comparable as it was when it lost 31%. That was when it went from like 12 to 9 or something in that area. So it's definitely in the volatile movements. Volatile movements means big up and down movements. It's very rare that this is to be the case. There usually has to be something on a fundamental level for this to happen. One of which would be that of a dollar collapse.